Hello everyone and welcome to the second session of Financial Accounting Essentials. I'm Chen. Last session, we've discussed balance sheets, especially on what it is, what's in it, and how to use it in an exam. Today, we're going to cover crediting and debiting, which focuses more on the transactions or the changes to the balance sheet. Let's get started. So last session, we concluded with the golden equation of balance sheet, which is that total assets, the uses of your finances, is equal to your total financing, the sources of your finances. And credits and debits ties very closely to this equation because every transaction or changes to the balance sheet will have to respect this equation in order to keep the balance sheet balanced. Let's present this with an example. So I'm going to purchase my office building by issuing a loan from the bank. So as a result of that transaction, my assets will increase by the value of the office building, and my liability will also increase from the loan that I issued. So in this situation, there is one credit and one debit, but one thing you need to know is that the credit will always equal to the debit for each individual transaction. Let's give another example of transaction. So let's say I want to purchase a car for my company, but I don't have enough cash to cover it. So in the end, I pay part of the payment from my cash account, and the other part of my payment in credit as an account payable in my liability. So what will happen in the end is that my assets will increase by the value of the car, but decrease from the cash that I paid, and my liability will increase from the amount of accounts payable that I issued for this payment. So you might be able to notice that many accounts are being affected from the singular transaction. And that's exactly the case. In a singular transaction, many accounts can be credited and debited, which means that the value of it can be changed up or down depending on what kind of transaction it is. However, it is important to note that in a singular transaction, the amount that is credited in the balance sheet will always equal to the amount that is debited in the balance sheet. In order to better understand crediting and debiting, especially on the accounts that it affects, it's better to look at it through T accounts, which are a series of records showing changes in each individual account in the balance sheet. So here you can see the T accounts under each individual category of the balance sheet, where assets equals liability plus equity, which are the golden equation we discussed earlier. The T accounts basically sums all the informations, all the transactions that change the accounts, and sum them all up into one single T account. From the last example, we discussed that we financed an office building from issuing a loan at the bank. So what will happen is that your assets will increase, which means that you are debiting your assets, and your liability will increase, which results to crediting of your liability. So the T accounts and also the effects of the T accounts in each individual category basically explains what will happen or what exactly is happening to your accounts while they're being changed from transactions. So what you need to know about T accounts, or just crediting and debiting in general, is that whenever on the total asset side an account increases in value, that means it is being debited, and it's always on the left side. Debiting is always on the left side. And whenever it decreases in value, it's being credited. Vice versa, on the total financing side, whenever an account is being debited, it decreases in value, and whenever it's being credited, it increases in value. So that goes with equity as well. So now we're going to cover the expenses and revenues T accounts that are going to appear in your exam. So obviously, they do not belong in the balance sheet. However, they do affect a certain aspect in your balance sheet, which is your net income that belongs in equity. So the reason why I put these symbols, or plus and minus, in its respective spot is because whenever an expense increases, it's going to debit your net income. So that means it's going to decrease it in value because expenses decrease your net income. So when your expense increases, it decreases your equity. So on the other side, when it decreases, you have less to spend, you have less that are expended, you have more net income as a result. And for the revenue, it's kind of the opposite situation, where an increase in revenue can lead to a crediting of your balance sheet because now you have more net income, and debt decreasing in value will lead to a debiting of your balance sheet, which will decrease your net income. So to summarize, debiting causes an increase in total assets and decrease in total financing, whereas credits will cause a decrease in total assets and increase in total financing. Whenever a transaction occurs, no matter how many accounts it is being debited, the amount that's being debited will always equal to the amount that's being credited in order to keep the balance sheet balanced. I hope this session has helped you out, and definitely check out our website for more information, especially on the categorization of what's an asset, what's a liability, and what's an equity. And definitely consider signing up for our private tutoring program if you would like that. And I hope this helped you out, and have a good day.